In 1869, two financiers in New York decide to corner the gold market. Their names are Gould and James Fisk. They are not respectable men. Gould has been accused of stock manipulation, bribery, and fraud. Fisk is known for extravagance and corruption. Together, they control the Erie Railroad through schemes that bankrupted previous owners and defrauded shareholders. Now, they want to control gold. The plan is simple. Buy as much gold as possible, drive up the price, then sell at the peak. But there is a problem. The U.S. government holds large gold reserves and occasionally sells to stabilize the market. If the Treasury releases gold while Gould and Fisk are buying, the price will collapse and they will lose everything. So they need to prevent the government from selling. And to do that, they need to control the president. Ulysses S. Grant is president. His brother-in-law, Abel Corbin, is a financier with debts and ambitions. Gould cultivates Corbin. He offers him money, investment opportunities, insider access. Corbin introduces Gould to Grant. Gould wines and dines the president. He argues that high gold prices benefit farmers by making American exports cheaper abroad. He implies that the government should not interfere in the gold market. Grant listens, but says little. Gould interprets silence as agreement. Gould and Fisk begin buying gold in summer 1869. They buy through proxies to hide the scale of their accumulation. The price rises slowly at first, then faster. By September, gold that had traded at $130 per ounce is approaching $145. Other speculators notice. Some join the buying. Others, sensing a manipulation, start shorting, betting the price will fall. The market becomes a war between bulls and bears, with Gould and Fisk controlling the largest position on the bull side. But Gould has a problem. He has been buying gold with borrowed money. If the price does not keep rising, he cannot meet his obligations. And if the Treasury sells gold, the price will collapse instantly. He needs to keep the government paralyzed. So he sends Corbin to Grant with a letter begging the president not to sell gold. Grant, finally realizing he is being manipulated, orders the Treasury to prepare a sale. Corbin warns Gould. Gould begins selling secretly, dumping his gold while publicly urging others to keep buying. He is betraying his own conspiracy. Friday, September 24th, 1869, the price of gold hits $160. Fisk is still buying, unaware that Gould is selling. The Treasury announces it will sell for $1 million in gold. The price collapses. Within minutes, gold falls to $133. Traders who bought at $160 are ruined. Brokerages fail. The stock market crashes. Banks call in loans. Businesses cannot meet payroll. The panic spreads from New York to every financial center in the country. It becomes known as Black Friday. Fisk, realizing he has been betrayed by Gould, tries to escape his obligations. He claims his trades were unauthorized, made by a clerk without his knowledge. He refuses to honor contracts. Lawsuits follow. Some traders pursue Fisk with guns. He hides in a theater he owns, protected by hired thugs. Gould, who sold early, escapes with a profit. He made millions, while others lost everything. The corner failed. But Gould won anyway because he cheated his own partners. This was not an isolated event. Financial markets have been manipulated for as long as they have existed. Corners, schemes to monopolize a commodity or security, and then exploit the artificial scarcity appear throughout history, and they follow the same pattern. Accumulate quietly, drive up the price, create a squeeze where others are forced to buy at inflated prices, then exit before the collapse. The profit comes not from creating value but from exploiting panic. Corners work because markets rely on trust. Buyers assume sellers will deliver. Sellers assume buyers will pay. When someone secretly controls the supply and manipulates the price, that trust becomes a weapon. Those who shorted betting prices would fall must buy to cover their positions. But if someone has cornered the market, there is no supply except at extortionate prices. The shorts are trapped. They must pay whatever the manipulator demands or default, and default means ruin. The Hunt brothers tried this with silver in 1980. Nelson Bunker Hunt and William Herbert Hunt were Texas oil billionaires. They believed inflation would destroy the dollar and silver would become a safe haven. They began buying silver in 1973. By 1980, they controlled an estimated 1/3 of the world's deliverable silver supply, excluding government reserves. The price of silver rose from $6 per ounce in 1979 to $50 in January 1980. The Hunts borrowed heavily to finance their purchases. They used silver as collateral for loans and bought more silver with the borrowed money. This leverage amplified their control, but it also made them vulnerable. If the price fell, their collateral would lose value and lenders would demand more margin. The Hunts would have to sell silver to raise cash, which would push prices down further. It was a feedback loop waiting to trigger. The commodities exchanges noticed the corner. They changed the rules. They increased margin requirements, making it more expensive to hold large positions. They limited how much silver any single entity could buy. The new rules were aimed directly at the Hunts. The price of silver began to fall. By March 1980, it had dropped to $21. The Hunts faced margin calls they could not meet. They tried to borrow, but banks refused. On March 27, 1980, Silver Thursday, The Hunts defaulted. Price crashed to $10. The Hunt brothers lost billions. Their brokerages nearly failed. The commodities market was paralyzed. The Federal Reserve had to intervene, organizing a bailout to prevent systemic collapse. The Hunts were eventually prosecuted and found guilty of conspiring to manipulate the market. But the damage was done. Investors who had bought silver, expecting it to keep rising, lost fortunes. The Hunts, like Gould before them, had created a bubble, exploited it, and then collapsed it, taking everyone else down with them. Corners are illegal now in most markets. Securities laws prohibit manipulation. Regulators monitor for unusual trading patterns. But enforcement is difficult. Markets are complex. Manipulation can be subtle. And the line between aggressive trading and illegal manipulation is not always clear. Traders who accumulate large positions can claim they are simply bullish, not manipulating. Proving intent is hard. And some corners are legal. Corporate raider who buys shares to gain control of a company is cornering the stock. Shareholders who refuse to sell can demand high prices. The raider must pay or abandon the takeover. This is normal market behavior, but it operates on the same mechanics as an illegal corner. Control the supply, exploit the demand, extract maximum value. The difference is legitimacy, not mechanism. Short squeezes are a modern variation. When a stock is heavily shorted, meaning many traders have bet against it, a sudden price increase can force shorts to cover. They must buy the stock to close their positions. But if everyone is buying at once, the price spikes. This creates a feedback loop. Rising prices trigger more covering, which pushes prices higher, which triggers more covering. The shorts are squeezed. This happened with GameStop in 2021. The stock was heavily shorted by hedge funds who believed the company was failing. Retail traders, organized on internet forums, began buying shares and options. The price rose. Hedge funds faced margin calls and had to cover. The covering drove the price higher. GameStop, which had traded at $20 in January, hit $483 by late January. Hedge funds lost billions. Some nearly collapsed. The retail traders profited, at least those who sold before the price fell back. The GameStop squeeze was not a traditional corner. No single entity controlled the supply, but the mechanics were similar. Coordinated group bought aggressively, creating scarcity. Those who were short were trapped. They had to buy at inflated prices or face ruin. The difference was that the coordination happened publicly on social media, not in secret meetings. And because it was decentralized, it was harder to prosecute as manipulation. Regulators struggled to respond. Was this market manipulation or just collective action? Were the retail traders guilty of a scheme or simply exercising their right to buy stock? The law was unclear, and the difficulty of assigning blame when thousands of people are acting independently, even if coordinated loosely, made enforcement almost impossible. The squeeze revealed a gap in regulation. The rules were written for a world where manipulation required centralized control. It did not account for decentralized coordination enabled by technology. Corners also appear in commodity markets. In 1980, the same year as the Hunt silver corner, there was a corner in soybeans. In 2008, there were accusations of a corner in oil, though this was never proven. In 2010, cocoa prices spiked when a single hedge fund bought a massive position. Each time, the pattern repeated. Accumulate, squeeze, exit. And each time, regulators promised reforms. But reforms are reactive. They address the last manipulation, not the next one. And manipulators adapt. The difficulty is that markets depend on liquidity. Liquidity means the ability to buy or sell without moving the price significantly. But liquidity is provided by people willing to take the other side of a trade. When someone is cornering a market, liquidity disappears. No one wants to sell because they suspect the buyer is manipulating. No one wants to buy because they suspect the price is artificial. The market freezes, and a frozen market is non-functional. It cannot allocate resources, cannot price risk. It is just a battlefield where manipulators fight each other and everyone else loses. This is why corners are so destructive. They do not just transfer wealth from losers to winners. They destroy the market's ability to function. After the 1869 gold corner, trust in the gold market was shattered. Traders became paranoid. Liquidity dried up. It took years to rebuild confidence. After the Hunt silver corner, silver markets were disrupted for a decade. After GameStop, retail brokers restricted trading, which angered users and raised questions about whether markets were rigged. Each corner leaves scars. But corners keep happening because the incentives are powerful. If successful, a corner generates enormous profits with relatively little capital. The leverage comes from controlling supply, not from owning it outright. A trader who controls 10% of a commodity can dictate prices if that 10% is the marginal supply, the amount needed to clear the market. Everyone else must deal with the manipulator, and the manipulator extracts rent from that bottleneck. This dynamic appears everywhere. OPEC corners the oil market by coordinating production cuts among member states. When OPEC restricts supply, oil prices rise. Consumers pay more. OPEC members' profits is legal because it is done by sovereign governments, not private actors. But the mechanism is identical to a market corner. Control the supply, create scarcity, exploit the dependence. De Beers did this with diamonds for most of the 20th century. It controlled the majority of diamond production and distribution. It restricted supply to keep prices high. Diamonds are not actually rare, but De Beers made them scarce by hoarding supply and controlling how many money entered the market each year. The artificial scarcity created the perception of value, and that perception, maintained through marketing and supply control, turned diamonds into a luxury good. The corner lasted for decades because De Beers had the power to enforce discipline on producers and the market dominance to suppress competition. Technology companies do a version of this with patents and intellectual property. A company that controls a critical patent can charge whatever it wants to license that technology. Others must pay or be excluded from the market. This is a legal monopoly granted by the state, but it functions like a corner. The company controls access to something essential, exploits that control to extract maximum rent, and the cost is passed on to consumers. The financial system itself operates on a form of corner. Central banks control the supply of base money. Commercial banks control the supply of credit. Between them, they determine how much money exists and who can access it. This is not a conspiracy. It is the structure of the system, but the structure creates leverage. Those who control money creation can dictate terms to those who need money, and because money is required for nearly every transaction, the leverage is total. This is why financial crises are so devastating. When banks stop lending, money effectively disappears. Not physically, but functionally. Businesses cannot borrow to cover payroll. Consumers cannot borrow to buy homes or cars. The economy seizes because the institutions that control credit have withdrawn it, and they withdraw it not because there is no wealth or productive capacity, but because they perceive risk. The corner is not in a commodity. It is in liquidity itself. And when liquidity is cornered, everything stops. Gould and Fisk understood this in 1869. They were not trying to corner gold because they thought gold was undervalued. They were cornering it because they knew that a short squeeze would force others to pay irrational prices. The gold itself was irrelevant. The mechanism was everything. Create scarcity where there is dependence. Exploit the panic. Exit before the collapse. It worked for Gould. It destroyed everyone else. The lesson from corners is that markets are not self-regulating when someone has enough power to manipulate them. The invisible hand assumes no one can control supply or demand. But when someone can, the hand becomes a fist, and the fist extracts. It's not through value creation, through exploitation of position. Gould did not make America richer. He made himself richer by creating chaos. The Hunts did not add value to the silver market. They distorted it for personal gain. Every corner is a theft disguised as trading. Regulation tries to prevent this, but regulation is always behind. Manipulators innovate. They find new assets to corner, new methods to coordinate, new ways to exploit gaps in oversight. And by the time regulators catch up, the damage is done. The traders are rich or bankrupt. The market is scarred. And the next manipulation is already being planned. A trading floor in New York, September 1869. Messengers run between desks shouting prices. Gold is at $162, then $158, then $140, then $133. Fortunes are evaporating. Men are screaming. Some are weeping outside. A crowd gathers, waiting for news. The streets are full of ruined traders. In a quiet office uptown, Gould counts his money. He sold early. He knew the government would intervene. He knew Fisk would be the one holding the bag when it collapsed. The corner failed, but Gould won. Because in a corner, the one who exits first takes everything, and everyone else is left with nothing.